Bloomberg Audio Studios. Podcasts, radio, news.
Hey, Joel here. Before we get started, Eric and I have a favor to ask. We're doing a quick 3-question survey to better understand the community listening to Trillions. It's anonymous and takes just a few seconds. You can go to trillionsurvey.com/Bloomberg to answer. That's trillionsurvey.com/Bloomberg. Thanks for supporting the show. Welcome to Trillions. I'm Joel Weber.
And I'm Eric Balchunas.
So here we are in December. And this year, if you think about ETFs, will go down in the record books for a pretty significant reason. What is that reason?
To say the least. So there's 3 main records, right, or metrics that ETFs we track all year. Launches, flows, and volume, right? Those are like, we call it the Triple Crown. Normally, in a good year, you get flows and launches are up, right? Everybody's happy. But volume isn't high because volume tends to go up when people are nervous or tweaking their portfolio, right? So in 2022, when the market was down, volume was a record. So the last 2 years, it hasn't gotten to that point. But this year, the volume broke the 2022 record, even though it was mostly a good year. The flows also in record territory. And the launches, man, they've blown away. They might even get close to doubling the old record. So we have the rare Triple Crown, and each of these records is going to get broken by double-digit percentages. So this is like, you know, every year I'm like, this has to be as good as it gets. Like, this is ETFs in their prime, but this has to be it, Joel. I'm saying it right now. Like, I feel like they can't do this again. So I think it's good to just look at what happened, what's inside of those numbers, and what might happen next year.
Naive question. Have we ever had a Triple Crown before?
Yes. Don't laugh. 2021. I know that sounds like, well, it was only 4 years ago. But it's rare. It's only happened a few times in 30 years. The reason 2021 did it is because you didn't have that 2022 record of volume. So volume was a little easier to get over. And the other thing is 2021, if you remember, was an awesome year for stocks, right? That was like the last awesome year where I think stocks were up like 25% or something. Everything was going right in 2021 until the Fed raised rates in 2022. That's why I do think this year, after the tariff tantrum came and went, it has some 2021 vibes.
So joining us to talk about the Triple Crown, Todd Sohn. He's a senior ETF fund and technical strategist with Strategas Securities, and Katie Greifeld, cross-asset reporter with Bloomberg News, as well as the co-host of Money Stuff and also like a TV phenom.
The Close, ETF IQ.
All of it. This time on Trillions, Triple Crown. Todd, Katie, welcome back to Trillions.
This is my Super Bowl. I appreciate being here.
Super Bowl, Triple Crown, we got a lot going on.
I am thrilled for the opportunity, though I will say I thought we were going to be talking about horses, so
well,
a little bit of a letdown.
The perfect segue.
Well, hold on. Can we start?
Every Triple Crown has a horse's name, right? Like 2021 should have had a horse's name. If 2025 had a horse, what would you name it?
Oh my God, Joel! I need like 7 seconds to think
Degen.
about that. Degen.
Yeah,
That's appropriate.
because the Vanguardians are always there, but this year the Degens really showed up.
I mean,
Degen the horse.
I think Degen is perfect.
Okay, all right.
By the way, speaking of horses, can we just take one quick little personal note here and talk about Katie's neck tattoo?
Oh my God.
So she got a neck tattoo. Can you tell us the story behind this? Because I am intrigued. Just
Really?
I know horses are involved.
Yeah, really quick. I had a pony named Batman. My parents bought him when I was 11, which is crazy. And he passed away this past May, the day before my 32nd birthday. So that was a long-term relationship. That horse was like a brother. So I always knew I was going to get the bat signal once he left this earth. And
you actually got a neck tattoo.
I did. But it's hidden. You'll never see it on TV.
Okay.
You'll only hear about it on this podcast.
Okay. And maybe
money stuff.
Yeah.
It's exclusive.
And maybe on my Twitter.
Where's your tattoo?
I'm ink free. Okay, so this was the Degen year. This was
far. I could see midlife crisis creeping up sometime soon.
Just sparkle in your eyes.
Yeah, we're just gonna skip that one. Okay, so let's start with launches. How significant? You said double digits for everything. Like how many launches were there so far? Obviously, there could be more between now and the end of the year.
We're around 930 launches this year with 4 weeks to go. Now, last year the record was, I think, 710, 720. But the record before that was like 550. So we're probably going to double the 550 record, which was only 2 years ago. Whether we get to... The reason we could get... There's an outside shot. There's a bunch of 3X and 5X ETFs that were filed. Like, I'm talking like 400 of them. And they do come due maybe in December. I don't think the SEC is going to allow them. But if they did, we're talking like it could be a couple hundred.
5X?
Yeah, I know.
Wow.
That they're going to... They love to push the envelope in this industry. They feel like they have a workaround where they can use swaps plus options to kind of like get around the sort of... Because you're not allowed to have 3X in an ETF. I think the SEC is not going to allow any of that. We'll see. But if they did, that could be like dozens and dozens, if not 100 in short order, because they're all in this like major competition to get out because none of them... You got to be first to market in the leverage area to have like the most of the assets. The other thing is the ETF share class, although that's probably going to get pushed more into 2026. Even DFA, who I think will be first, is probably not going to launch this year. So we're looking at probably anywhere between 1,000 and like 1,150, I would say, when all the dust settles. So that's probably, what, a 60, 70% increase over last year's record?
Todd, how successful will those launches be?
I think it depends on what you're looking at. Going back to Degen, leverage was a huge part of this year, right? There's been 1 out of every 4, maybe a third of launches have involved leverage, right? And part of this is the single stock leverage space. So this year you've had over 200 of those involving single stock leverage. And I think the interesting part is we're just throwing stuff at the wall. You started with blue chip companies, Tesla, Nvidia a few years ago, and now we're just going for anything sub 10 billion that might catch fire. So back to your question, how successful they are, a lot of them are at risk of closure. If the actual equity market does decline, like a 2022, I think a lot of them are going to close. But they have fully really contributed to that launches aspect. And Eric mentioned the 3X, 5X potential. Man, this thing's not slowing down.
And these 2X stock ETFs charge 100 basis points. So all you need is like one hit to be set for life. And so it's almost like a lottery system for the issuers because they just get one hit, they're good. And what I found interesting is I get Tesla and Nvidia 2X being big hits. Okay, fine. But there's stuff that gets put out that I've never heard of the stock, Joel. I'm like, I have to like Google it. And I'm like, it's some random quantum stock that is like a small cap. And all of a sudden I look up, the thing's trading like 20, 30 million a day. It's got 100 million. And so you even got mid-range hits. I wouldn't call it a blockbuster. But there's a lot of appetite. And so the industry is feeding the degens because the degens are hungry.
I will say, I mean, to Todd's point, we'll see if this turns into closures. It's also going to be interesting if we do get into the really highly leveraged stuff 3 times, 5 times, whether or not those funds will eventually be closed or whether they're going to implode in some way. Because I think that was one of the more interesting tales of the past couple months, that you had that European listed 3 times AMD product. There was a single day where AMD announced some partnership. I think it was with OpenAI. It feels like everything is with OpenAI.
That's the circular financing.
It's very
Yeah,
circular,
right.
yeah.
But it was an inverse AMD fund, right? And it AMD surged double digits, and this fund had to close. So that's certainly going to be fun to watch. The other thing I would add to this conversation is, you know, there's a lot of these single stock funds that are launching. That probably explains the high number of new funds coming to market. There's also a lot of new issuers who are coming to market as well, who are behind these funds. I know there's a Bloomberg intelligence stat that I think there's 60 new ETF firms that have entered the industry over the past 2 years, which is also pretty stunning.
Yeah, no, I think there's 300 total firms and 600 brands. One quick thing on the leverage, Athanasios did a study on my team that found that if they put the 3X and forget 5X, just 3X, if they do all these stocks in 3X, there is going to be an implosion like every other week because a lot of them go up 33% or down 33% pretty regularly. What's also interesting about the negative 3X AMD in Europe is almost all of these leverage ETFs are launching are long. Like it's almost like a 9-to-1 or 10-to-1 long to short. However, in that little pullback we had like 2 or 3 weeks ago, that everybody freaked out about. It was like 4% from all-time highs, and people are ready to call it the year's over. They saw some launches of inverse of these quantum because people were like, oh wait, we forgot things can go down. So some of these launches, they're probably going to put the inverse out so you can bet the other way. Now there's inverse and long. I think that does increase the likelihood of a couple terminations. However, Ethan and I talk about this all the time. We're like, we don't think the degens care. You know that scene in Mad Max Fury Road? They're just like cruising along and like one of the cars just wipes out and they just look behind them and they just keep going. Like nobody really cares. They just keep driving. That to me is what I think this will feel like. If we have an implosion, like if the granite shares, something has to close, they'll just go, oh, that's a shame. And they'll just keep degenning as we go forward.
It's a big portion of the number, but not assets.
The media will be like, oh my God, implosion I get. But I don't think the users care. They're just like, whatever, on to the next one.
Classic media.
Well, come on, termination, implosion.
It's pretty good.
Yeah, I know.
Blow up. All these fun words. We don't usually get to use them.
By the way, just to bring it back to ponies.
Yeah, thank you.
To be a Triple Crown, to be a Triple Crown winner, you got to win A, the Kentucky Derby, B, the Preakness, and C, the Belmont. Which is launches? Is that the Derby?
To me, the Kentucky Derby would be flows. That's the most important because that is net new cash coming in. That's votes.
Okay. So we've messed up our order already. But let's go ahead and let's start talking about flows.
The flows this year, Joel, 1.24 trillion with a T. And there's still a month to go. And
maybe we
December
should have a podcast about this.
I think they'll see 60 billion in December. That's about the monthly haul lately. And so I think we're going to end at 1.3 trillion. Now, that'll be 200 billion over the record. The record last year was 1.1 trillion. And again, that was the record. Like, it's just record after record. When we look at that number, it's enormous. If I take you over to mutual funds, collectively, I think they're around negative 700 billion in outflows. So there's like more money going to ETFs than leaving mutual funds. All the equity side is worse. And if we look at the number of ETFs that have taken in flows, we are at 3,379 of 4,769. So that's, the getting is good. Everybody's getting bites. If you're in that 1,000 that's not, you should probably just pack it up. Because if you can't catch fish in this environment, like you are using the wrong bait, you're a bad fisherman, you got to go.
What jumps out to you in that category?
Just the flows?
Yeah.
First of all, VU, 124 billion. It has a real shot to get to 140, 150. That's also a record. So for a single year. And then IVV is right behind it. I would say if anything was kind of shocking this year would be the cash-like ETFs did better. SGov, the treasuries, and gold. GLD at 19 billion, that old dog. There's cheaper gold ETFs. So for that old war horse to, I'm sticking with the horse theme.
I love this.
Yeah. For that to finish in 8th place is pretty compelling this year. But to me, the flows were summarized this year as, okay, I am not going to try to time the market, so I'm going to buy equities. And I'm not going to let anything scare me. Even during the tariff tantrum, the investors were not scared. They're like, I'm buying equities. However, they did want to get some protection on the side, so they bought gold and treasuries. So we saw some safety dance going on with those, plus the equities, which for ETFs is good because that means just they're buying everything pretty much.
Beta with a side of Balchunas.
There you go. Well, no, that would be like 2x crypto, which is also what was going on.
The one other area that does stand out in terms of inflows is a revival in thematic funds too, right? Nuclear, power generation, I guess AI, if you want to call it that. Without
data centers.
Data centers too. Without really a massive participation from the ARK funds, right? Think back to 2021, the prior record that was led by thematic funds. ARK did big business then, and now you've
owned the year.
They were the thematic player. Now that's really spread out across. So thematic funds are back, I think, as a complement to the VOO, the IVVs of the world too. So that's pretty interesting to me. And then on the names that haven't participated. 2 areas, maybe this is a 2026 story. Small caps, right? People gave up on small caps.
Okay,
Which is interesting.
Let's unpack that.
Hold on.
Yeah.
What's the other one?
low volatility
Okay.
Oh, okay. Well,
factor.
I don't even know what to attack first.
Do small caps.
I'm gonna give you the counter.
Yeah.
These Mag 7 stocks and others, anytime a company is worth anything now, it just gets
they buy it
bought.
up.
It's
Yep.
like the Lakers taking all the good players before they even go to college. You know what I mean?
Yep. Totally.
So small caps used to be a prospect area of like good companies that just IPO'd and like they're rising stars. Well, they wait later to IPO until they're large caps. So they skip that area. And if they're worth anything, they get bought by these big companies who the Mag 7 has acquired almost 900 different companies. So isn't small caps really just a dumping ground now instead of like a farm system?
They have a structural problem, right? These companies, as you said, they either get acquired or once they IPO, they're already a large cap. It's interesting, though. They've had a good run here the last 8 months, probably because of the quantum stuff and the meme-esque type funds, which are basically the top of the Russell 2000. So maybe the tune is changing.
Do mid caps even exist anymore?
I just loop in with small caps.
Yeah.
They
It's mid.
definitely do, though. I hear so many beautiful bull cases built around small caps and also mid caps. And I mean, to Eric's point, it seems like there's been so many false dawns. The supply problem, though, that you guys are talking about is really interesting, that you don't have these smaller companies coming to market. And it feels like tech companies are the last true conglomerates in terms of just buying everything up that looks promising.
If you aren't going to enforce antitrust laws, then there's a secular change going on. Because I looked, GE was the last mega company to like run the S&P 500. Like back in the 2000s, GE was like the biggest stock. Remember?
The Jack Welch.
It was 50% of the industrial sector.
Yeah, I mean, it was the Mag 7 of its day, right? It acquired 70 companies, which is a lot. Google has acquired 250. Microsoft, 250. Like, these are on another level. And some of the companies that are acquired would be top 50 names otherwise. So I think until they break up these companies, that's why I'm like, if you don't own the Mag 7, it's almost like you don't own small caps too, in a way, if you think about it from a certain point of view. That's why this whole idea of like CFAing the market, I just think it's bad news. You got to think a little more like a degen or a momentum trader and just ride it, because it's not the same as it was. And I know that's like famous last words. Things do revert, but
especially if we're comparing this to 2021, and 2022, as we all remember, was a very dark year.
However, in 2022, the Fed raised rates, and like that was like that was like the cop showing up at the party. It's over, right?
Take away the punch bowl.
Now
We're all drinking
Trump
underage.
is gonna nominate some yes man who we could have negative rates this time next year. I mean,
Remember that?
they might give
experiment.
you money. So it's not 2022 next year unless there's some black swan we're not envisioning. We'll see though.
Yeah.
Do you want to take a flamethrower to the low vol category?
Yeah. So Athanasios wrote this great note that buffer ETFs killed the low vol star.
I agree with that.
Yeah.
Totally.
Okay.
Yeah.
So what do you say to
they
that?
have a proliferation of other options problem.
Yeah.
And you just haven't needed them either, right? Outside of April, there's been no reason to own low vol defensive type strategies.
I mean, I just think buffers are more guaranteed. It's not guessing. It's like, when you do that machine where you get the football helmet or the piece of candy from the quarter machine. Remember back in the day?
Comes out in the little
And
plastic
you're like,
bubble.
I don't know what I'm going to get.
Yeah.
That's more like low vol. It'll probably go down somewhat less. Whereas the buffers, they lock in your performance. And I think if you're older with a lot of money on the line, you'd rather have that guarantee than just like wing it with low vol.
A defined outcome, if you will.
Exactly.
And keep in mind, you get 3.5% to 4% on Treasury bills, ETFs, right? Why am I going to own a low vol ETF that I'm yielding less and I'm also taking equity risk? So
I know.
it's just-
They're in a
just-
bad spot.
Yeah, I just think it's interesting that them and small caps have just been entirely left for dead.
Well,
We'll see.
when you're
But
in a,
those are the reasons, though. I mean, they're pretty
totally.
good reasons. They're
Yeah.
not market reasons. They're more structural in a way.
Right.
I'd like to bring it back to ponies again.
Yeah, thank you.
Which is, if you've won the Derby and you've won the Preakness, what is the Belmont?
Volume.
So let's talk about
Yeah,
Volume.
ETFs are going to trade. ETFs are going to trade in the neighborhood of $60 trillion worth of shares this year.
Yeah.
Right now, they're at 53.5. The old record was in 2022, right, when hell was breaking loose, at 47 trillion.
so a third more.
Yeah. And every category is up, like fixed income, equity. Everything is way higher than it was. So it's not just like one thing. I will say the degen factor, all those 2x ETFs, they're like born to trade. So like they definitely add a little kick. But I just think the reason this number is higher is because of the flows, which attract more issuers, as Katie mentioned. And if you just have more products and more volume and more like big legacy firms trying to push their ETFs, you just have a bigger tent and it's more popular. So some of this is just the expansion of ETFs. I think the degen bid helps a little bit because people love trading. And I also think that, honestly, 53 trillion isn't what it used to be, Joel.
So 2022.
Yeah, I mean, 53 trillion today is like 10 billion 10 years ago. Just kidding. It's not that crazy. But like, you ever notice like numbers are just like, they're just like, this brings it back to like.
Could you draw a direct line between the number of leveraged ETFs and that volume? Is that,
Yeah, I mean,
all these leveraged ETFs come out. That's
the trajectory of levered volume, which is either single stock or the index-based ones, is slowly been climbing.
Yeah.
And that's because you're in a bull market, and so people like to add on leverage. And whenever there's a downdraft, you see the inverse volume spike. But that usage rate has definitely climbed. You think about, Eric and I, we always talk sports. It's a player that's being constly more involved.
Can you stick with the horse metaphor?
Or
Yeah, please.
a horse.
A jockey.
A jockey.
You can bring in a
jockey's
human.
he's using all different horses.
So I can tell you 5 trillion. So 10% of the volume is leverage, which is a lot because they only leverage makes up 1% of the assets, 10% of the volume, which is good because you don't want people holding the stuff. You want them to trade it.
The other interesting aspect is there's other corners that'll pop up every now and then outside of equity and leverage. So like gold. Remember gold probably 6-7 weeks ago? GLD was doing massive volume. And GLDM, silver, the whole precious metal spectrum, that also contributes to that tally. So what's happening is when someone needs exposure, whether it's long, short, or an adjustment, you're seeing them go to ETFs more and more and more, which I think is great for the industry. But every now and then you see an ETF, a random one, pop up in the top 5 to 10 most traded.
The other thing is a lot of this volume is coming from overseas. I've just traveled the world this year pretty much, and the volume isn't growing as fast as you think it would overseas. If you are a pension fund in Japan, let's say, you might use EWJ over your own homegrown Japan ETF, which is weird, right? But these institutions, the bigger you are, the more you require deep liquidity. So the U.S. is kind of like a vampire sucking liquidity from all over the world. And it's unfortunate. And there's certain ways these countries are trying to fight back, but it's hard because it's just tough. You put out like a gold ETF in your country, and then this institution is like, well, GLD trades like 4 billion a day. You trade like 10 million a day, if that.
Yeah.
And they don't want to. They're going to put a 40 million position on. They're obviously going to go to the more liquid one.
You're seeing that in listings overall when it comes to companies as well, that people are listing their companies in the U.S. because that's where the liquidity is. That's where the depth of capital markets is. And I feel like, this is a tentacle of that you're seeing the U.S. becoming a vampire of sorts when it comes to ETFs as well. But I do think that, Todd, you make a good point that like the muscle memory is just there now, especially in a time of crisis. That's when you see SPY volume spike, for example. People have that blueprint down that the market is in turmoil. I'm going to go to ETFs because I know I'm going to get that exposure, and it's probably going to be fairly liquid, at least relative to my other options.
Oh, absolutely. I mean, the one item we didn't talk about, we just talked about leverage, but the growth of volume and launches in other option-related categories, derivative categories, right? Option income, FX hedging, all that stuff too. That's definitely contributing as well. I mean, the options market in terms of activity has also exploded.
This has been a big year for options. Katie, bring us home.
Yeah.
Home stretch of the Triple Crown. What do you make of all this, and what do you think 2026 is going to look like?
I do think it's interesting that we haven't talked about active really at all. I mean, sort of through talking about all of these options-based ETFs, these single stock ETFs, those count as active in terms of classification, but they aren't traditional stock picking. But it feels like that was another big story in 2025. It was the story in 2024. And I have to imagine it'll be a big part of the story in 2026 as well.
Well, and when you think about that, what was it, 60? Was it 60 new issuers? Like, where's the white space here? It's got to be mostly active.
Yeah, especially when you think of share classes actually arriving in 2026. I think that a lot of your traditional mutual fund shops with their mutual fund lineups, probably a portion of which is active, are going to try to grab that ETF lifeline.
Todd?
I think if there are more cuts to interest rates, perhaps there are down the line, I would keep an eye on the $7 trillion in money market assets. Not that those are going to go to stocks, but as Katie mentioned, active and an active fixed income. Because you're going to want to get that yield somewhere if you're not getting it from money market funds. And ETFs are the next best way to play that.
Also, the ETF share class, if that comes out, again, you're inviting the fox into the hen house, because these clients who are sitting in this mutual fund, which, again, it's like owning a compact disc in terms of technology, they're going to want to transfer over to the ETF class. And now, if they can do it with no tax consequence, this could be a real boon for ETF flows. This isn't the same as organic sentiment. When you see real, true organic sentiment, like a GLD this year or, like VU, it's interesting. Some of this BYOA sentiment where it comes over isn't quite as interesting, but to nerds and like people following the industry, it's very important. So there could be this drainage from mutual funds into ETFs that simply are the legacy managers sort of like slowly moving their clients over, taking the little bit of cannibalism hit because the ETFs won't charge quite as much as they used to make. But it helps them like be where the fish are biting now and like fight another day. And this is something that I think will drive flows and something that Katie wrote about with Capital Group. If you look at some of these legacy stock picking firms from like that were really big in the 90s, T. Rowe, Capital Group, DFA, if you look at their mutual funds, they see outflows. You look at their ETFs, they all see inflows. Now, we can't do one for one there, but clearly there's some cannibalization going on there. And that, I don't know, is that active working, or is that just like the current clients of this active shop are finally moving over to the new format? That's different than getting fresh bites. That's why a JEPI, right, or a JPST, when something is an organic hit, or even the Bitcoin ETFs, that's why it's so exciting, and we like grab it like a dog on a bone, because I'm like, it's hard to do this. And by the way, I want to cover one of, speaking of organic hits, this guy Bruce Bond, this billionaire now, I guess.
He is.
The buffer billionaire.
This guy, he built up PowerShares, sold to Invesco, and instead of just like going to retire in an island, he grew another firm called Innovator, which made the buffer ETFs, just sold it. Katie reported that he sold it for $2 billion. Can you tell us about this deal? Because to me, that's it's organic hit that is hard.
Yeah. Well, it sort of loops back to what we were talking about with all these upstarts entering the industry. I have to imagine the Bruce Bond model is kind of inspiring, how you would want your career to play out if you're one of these people with an ETF startup. The fact that he built PowerShares, he sold that. He built Innovator, just sold to Goldman for $2 billion, just identifying a need that people were going to desire, seeing what wasn't yet in the ETF wrapper. I mean, structured products have been around for a long time, but Innovator was one of the first to put that into the ETF wrapper in a way that could be packaged and sold and pitched to people. And it's interesting that Goldman decided to buy Innovator versus try to build it in-house. They do have buffer ETFs. They have 3, I believe, with 30 million in assets, but opted instead to buy Innovator, which is really an interesting move.
It is. And Joel, 10 years ago, if I had told you an active manager is going to come out with products that charge 90 basis points and they're going to make a killing and they're going to see quarterly flows break records every other year, I'm like, that's impossible. We're in the Vanguardian era. It's impossible. But that's what he did. And he did it by curing anxiety, because these boomers are all nervous as hell because they made a ton of money and they don't want to lose it all.
It's not quite degen, though, is it?
No, opposite. This is, if degens are looking for like adrenaline, these boomers are looking to sleep at night.
Yeah.
So they're like, I'll give up a lot of upside if you cure my downside, so I don't have to like worry about it. So Bruce Bond, if you own the stock market and a money market fund, some people say like it's as good as owning this long term, but the guarantee is powerful. And I think the emotions and psychology of investors are underlooked here. The other thing I will say is Goldman has been pretty quiet since Brian Lake joined. Now, Brian Lake is the driver of JEPI. I mean, he came out with the 2 biggest active funds on the planet, and he went to Goldman, he like disappeared. Hadn't heard from him in a while. This is interesting. I feel we'll have some other big news from Goldman. But get this, even with this acquisition, $28 billion firm, Goldman moved from 17th place to 15th place. Think about it. You're Goldman Sachs, one of the biggest brands in the world. You've been in the ETF market 15 years. You just bought a firm for $2 billion, and you still have 0.5% market share. That's how brutal this industry is, Joel. And that's how big Vanguard and BlackRock are, by the way. I mean, it's just the numbers are staggering. It's like when you look at like the planets and you see like Earth and Neptune, they put Jupiter on there and you're like, oh my God. Like it's just another level of these big firms. And it just shows you how tough this industry is. But the reason it's so tough is because the products are also good or pretty competitive and the investors like it. So it's hell for issuers, heaven for investors.
Final thought?
I mean, good job of you on that reporting, Katie.
Thank
one.
you.
And,
It was a team effort.
And Emily too, right?
It was me, Emily Greifeld, and Todd Gillespie.
I think this is very bullish ETFs to go along with the Triple Crown. I'm very curious to see now, do other asset managers start looking to that mid to lower tier for interesting issuers out there?
I think so.
Plenty to choose from.
I mean, we've long felt that the asset management industry in 10, 20 years from now will look like the airlines. There'll be 3 gigantic brands owning 75% of all the assets, basically BlackRock, Vanguard, and State Street, plus like 10 other issuers. And then there'll be like real specialty niche, like Alaska Air or like Costa Rica Air.
Sounds like a bunch of large caps and small caps. Ooh. See what I did there?
I don't know. I don't know if that was a zinger. I'm not sure what that was.
All right. Something.
But all I do know is consolidation is coming. It has to.
Yep, exactly.
Todd, Katie, thanks for joining us on Trillions.
Thanks.
Thanks a lot. Great to be with you guys.
Thanks for listening to Trillions. Until next time, you can find us on the Bloomberg Terminal, Bloomberg.com, Apple Podcasts, Spotify, or wherever else you like to listen. We'd love to hear from you. Hit us up on social. Trillions is produced by Magnus Henriksen and Ryan Kessler. Amy Keene is our executive producer. Sage Bauman is the head of Bloomberg Podcasts. Bye.